International politics might seem distant, unfolding in faraway capitals and behind closed doors. But the impact of those decisions hits close to home every time you fill up your gas tank, affecting your daily routine and monthly budget. The price you pay at the pump is directly linked to global crude oil prices, which react instantly to political news, especially from oil-producing regions. Even a rumor or a single statement from a world leader can send prices soaring or tumbling. When conflicts threaten supply, prices surge, sometimes overnight, as markets brace for shortages. When peace seems possible, prices drop, offering relief not just to drivers, but to entire economies that depend on affordable energy. The recent Ukraine peace plan, championed by U.S. President Donald Trump, is a prime example of how diplomacy can ripple through global markets. The Ukraine conflict has kept energy prices high for years, fueling uncertainty about oil supplies and making every negotiation matter. News of a possible resolution sent shockwaves through financial markets, hinting at stability and a potential increase in oil supply. Investors and analysts scrambled to adjust their forecasts. As the risk premium fades, prices fall, impacting everything from energy company stocks to your wallet, and even the cost of goods transported by truck or plane. The market is driven as much by expectations and speculation as by actual supply, making it highly sensitive to headlines and rumors. Even the suggestion of peace can move billions of dollars and change what you pay at the pump, sometimes before a single barrel is shipped. So, when you see headlines about distant conflicts or peace deals, remember, your gas bill is on the line, and so is the price of almost everything you buy. The events of this past Friday were a stark reminder of how interconnected our world and our wallets really are, with global events shaping local realities. Geopolitics isn't just a news story, it's an economic reality for everyone, shaping the cost of living in ways we often overlook. The announcement of the peace plan sent shockwaves through the global financial system, with markets reacting almost instantly. It triggered an immediate and dramatic sell-off in global energy markets, as investors scrambled to adjust their positions. Traders feared that a resolution in Ukraine could normalize energy flows from Russia and Eastern Europe, potentially flooding the market with new supply at a time when demand remains uncertain and fragile. Oil prices tumbled in response. Brent crude fell 1.29%, closing at $62.56 a barrel, while the U.S. benchmark WTI dropped 1.59% to $58.06. These sharp declines erased weeks of gains in a matter of hours. These aren't just numbers on a screen, they represent billions of dollars lost in value overnight, impacting not only companies but also pension funds and ordinary investors. Energy companies felt the pain immediately. Europe's stocks oil and gas index dropped over 2.4%, wiping out significant market capitalization in a single trading session. Major players like Shell and BP saw their shares fall about 1.4%, while Norway's Equinor tumbled 2.3%, reflecting the sector-wide anxiety. Siemens Energy in Germany plunged nearly 8%, a staggering drop that underscored just how deep investor anxiety runs in times of geopolitical change. When oil prices drop, so do the profits and stock values of energy giants, forcing companies to rethink their strategies and brace for leaner times. The news of potential peace, while positive for the world, was undeniably bad for business in the energy sector, sending shockwaves through boardrooms and trading floors alike. Investors across Europe braced for a new reality. The era of high prices driven by conflict may be ending, and a period of volatility and adjustment is just beginning. The market's swift and severe reaction shows just how sensitive energy prices are to even the hint of geopolitical shifts, and how quickly fortunes can change. In the world of energy, a single headline can reshape the fortunes of entire industries, leaving investors and companies scrambling to keep up. The sell-off wasn't limited to Europe. Shockwaves rippled across the Atlantic, shaking up markets in the United States as well. American energy giants took a hit too, as investors scrambled to reassess the value of their holdings in light of the new geopolitical landscape. ExxonMobil's shares dropped 1.1%, wiping out hundreds of millions of dollars in market capitalization in just a matter of hours. Chevron's fell 0.6%, small percentages on paper, but when applied to companies of this size, it translates to billions in lost value almost overnight. For investors, it was a clear sign. Global politics can hit home fast, and even the most established companies aren't immune to sudden shocks. A one-day drop of over 1% in oil is a big deal, making some extraction projects less profitable and forcing companies to rethink their strategies. For years, oil prices included a risk premium for the Ukraine conflict, cushioning companies against uncertainty and volatility. The peace plan erased much of that overnight, removing a key factor that had propped up prices for so long. The broad decline in Europe's stocks oil and gas index shows this isn't about one company, it's the whole sector being revalued, as investors try to gauge what comes next. Siemens Energy's 8% plunge highlights how infrastructure companies are exposed to big strategic shifts, especially when the rules of the game change overnight. A potential end to the conflict could redraw Europe's energy map, leaving investors uncertain about future projects and the long-term direction of the industry. The synchronized fall in US and European stocks underscores how globalized the energy market is, with events in one region instantly impacting others. Political developments in one region ripple across the world, affecting investors everywhere and reminding us how interconnected today's markets have become. The sea of red on trading screens was a vivid reminder. Peace can be as disruptive as war for energy markets, upending expectations and forcing rapid adjustments. The world's most powerful energy companies are now facing a new, uncertain environment, where yesterday's assumptions no longer hold, and the future is anything but predictable. So, what's in the peace plan that rocked the markets? Developed by the US and Russia, it demands major concessions from Ukraine, ceding Crimea, Luhansk, and Donetsk, and pledging never to join NATO. For Russia, this would be a strategic win, removing Ukraine from the Western alliance and securing its territorial gains. The plan also calls for Ukraine to cut its military by a third, from 900,000 to 600,000 troops. In exchange, Ukraine would get vague security guarantees, but the details are unclear. After years of conflict and broken promises, many question whether these guarantees are meaningful. Would they come from the US, Russia, or international bodies? No one knows. The sacrifices demanded are concrete, the promises offered are not. That's why the plan is so controversial, and why markets reacted so strongly. Experts quickly voiced skepticism, calling the plan heavily tilted toward Moscow. Ukraine is asked to give up land, NATO ambitions, and military strength for vague promises. Guntram Wolf of Bruegel bluntly said the plan can't fly, especially the demand to shrink Ukraine's military while Russia remains a threat. Many see the plan as a list of demands, not a real negotiation. Forcing Ukraine to cede territory violates international law and sets a dangerous precedent: aggression rewarded with diplomatic legitimacy. Critics warn this could encourage future invasions elsewhere. Even if signed, a deal seen as unjust would likely breed resentment and instability, not lasting peace. Most analysts agree the plan may have moved markets, but its chances of real-world success are slim. The skepticism is as much about principle as practicality. In Kyiv, the peace plan isn't about economics, it's about survival. Ukraine is being asked to surrender regions it considers its own, home to millions and the site of immense sacrifice. Giving up NATO aspirations means accepting permanent vulnerability to Russia. Cutting the military by a third would leave Ukraine dangerously exposed. For many Ukrainians, these demands feel like capitulation, not compromise. The security guarantees offered are vague, while the losses are real and irreversible. The plan, largely crafted without Ukraine's input, is seen as an insult to its sovereignty. Ukrainian officials have already signaled rejection, calling this path to peace a dead end. For Ukraine, the stakes are existential, and the answer is clear. The peace plan isn't the only force moving energy prices. The U.S. Federal Reserve's upcoming interest rate decision looms large. Higher rates slow economic growth and energy demand, pushing oil prices down. A stronger dollar, driven by rate hikes, makes oil more expensive globally, further dampening demand. If the Fed signals lower rates, the opposite could happen, stimulating growth and energy use. This uncertainty adds volatility, independent of geopolitics. Friday's price drop reflects both the peace plan and broader economic jitters. The market is juggling multiple risks at once, making predictions tough. Energy prices are being pulled in several directions, not just by headlines from Ukraine. Adding to the confusion, new U.S. sanctions on Russian oil giants Rosneft and Lukoil took effect Friday. Sanctions usually mean less supply and higher prices, directly opposing the peace plan's downward pressure. By restricting Russian exports, the sanctions threatened to tighten global oil supply. Yet markets focused more on the peace plan's potential to boost supply, sending prices lower. If the peace deal collapses, attention could quickly shift back to sanctions, causing prices to rebound. These conflicting forces are fueling volatility and uncertainty. Traders are left guessing which factor will dominate next. Predicting oil prices right now is harder than ever. What does all this mean for you? In a word, uncertainty. Political headlines can wipe billions from energy stocks and change what you pay at the pump overnight. Falling oil prices might bring short-term relief for drivers, but the situation is unstable. If the peace plan fails, prices could rebound just as quickly. For investors, conflicting signals from geopolitics, sanctions, and central banks make the market riskier than ever. The old rules no longer apply. Energy markets are in flux. The Ukraine peace plan is a powerful new variable, but its future is unclear. Economic factors and sanctions continue to shape the outlook. Whether you're a consumer or an investor, stay alert. The road ahead is likely to be bumpy. In today's world, global events are never far from your wallet.